Let's continue our discussion from where we had stopped yesterday. Yesterday, we were discussing about SEBI guidelines for issuing shares. So, SEBI has a prescribed set of five criterias which a company should adhere to in order to issue shares. But SEBI also has alternative options in case if a company is unable to fulfill those five criterias, still a company can issue shares. So there is obviously an alternative option. These five criterias are based on net tangible assets, average pre-tax operating profit, net worth, and then there are two conditions in which SEBI has identified how much money a company can borrow. So the amount of money what a company can borrow depends on its net worth. So SEBI says five times the net worth is what you can maximum borrow. Then SEBI has also put up a condition that how much minimum promoters should contribute towards the issue of shares. So SEBI says at least you should have 20% from your side when you are issuing shares. And then of course SEBI also gives an alternative options for all those companies who do not meet some of these criterias. For them the alternative option is available, and the alternative option has two conditions. One is that the issue has to be based on book building process. What is this book building process? Probably we'll discuss in today's session. Second condition is the quota system, the reservation system. So SEBI says in case if you do not meet any of these criterias, then you have to follow an alternative quota system in which 75% of the shares should be mandatorily issued to qualified institutional buyers. 15% has to be issued to the retail investors, and 10% has to be issued to the high net worth individuals. So this is the alternative option in case if a company does not fulfill any of the criterias mentioned or prescribed by SEBI. So in today's class, we will discuss to begin with different types of prospectors. So different types of prospectors are available, but one thing which is common in all these three types of prospectors, what we are about to discuss now, is that all these three types of prospectors contains comprehensive information about the company, except for few minor differences. Otherwise, the content is the same. It has all that information, which probably you would have gone through. I'm sure yesterday I had asked you to refer a prospectus. So I'm sure you would have definitely gone through some of those points that were mentioned in the prospectus, especially risk factors and the objects of the issue. So the first type of prospectus, which by and large is the most common type of prospectus, which is available on the website of SEBI. And in fact, yesterday when I shared those prospectus, those two were this category of prospectus only, which is draft offer document. So what do you mean by draft? As you are familiar with this word draft means a document which is in the final stage, which means it is yet to be finalized. It is ready, but it needs some sort of a ratification or observation or approval so that it becomes a final document. But some clearance is pending, because of which this is called a draft of a document, which means some sort of a review is pending. Otherwise, if the review is over, then it becomes an offer document. So the draft offer document is available on the website of Securities Exchange Board of India for public comments for a period of 21 days from the filing of the draft offer document with SEBI. So once the merchant bankers, with the help of company, they are the one who prepare the prospectus after taking the inputs from the company. So merchant bankers also do not take the responsibility for the content in the prospectus, because they have just prepared it based on what the company has provided to them. So the ounce of any kind of misrepresentation and fraud in the prospectus, the company is fully liable. So companies should provide the information and merchant bankers, they prepare the prospectus. So once this draft prospectus is ready, this has to be uploaded on the website of SEBI. Yesterday I had shared a link with you also. That was the link of SEBI's website. So this prospectus will be available on SEBI's website, and general public can comment in case if they come across any point which is not clear, for which clarification is required, or any of the point which the public thinks is not correct. So public comments are invited. So public can also comment, not just SEBI's observation. Public can also give their feedback and seek some sort of a clarification if there is any. Now, once the comments are received, if there is any, SEBI may specify changes. SEBI may notify the company that these are the things which needs to be changed, or these are the things on which we need more clarification. And if there is any change in the draft offer document, the issuer or the lead manager or the lead or so-called merchant bankers shall carry out such changes in the draft offer document. So once SEBI sends the observation letter that these are the observations made both from SEBI and from the public, so the merchant bankers need to look into those observations and make necessary corrections and changes to the prospectus as per the observation letter. So this is why we call this as a draft offer document, because this document is yet to be cleared. When will this be cleared? Once the SEBI issues observation letter, and once those points that are mentioned in the observation letters are incorporated. Once it is done, from draft offer document, it becomes an offer document. So that's the difference between offer document and draft offer document. The draft offer document is yet to be finalized. Only after observation letter, the changes are made, it becomes an offer document. Now, once draft offer document is approved, then what happens next? Then this document is submitted to the registrar of the companies. Registrar is a body that maintains records of all those companies which are planning to be listed on the stock exchanges, and all those companies which are already listed and doing business at the moment. So all the records of all the companies that exist in India are maintained by the registrar of companies. So once this offer document is ready, it has to be given to the registrar of companies for record keeping purpose. And the same thing has to be shared with all leading stock exchanges. So the same offer document is now available with the stock exchanges also. So on stock exchanges website, again, you can go and download. All the stock brokers also access stock exchange website. So they go through, they download this offer document and go through and prepare their research report, which they indeed share with the investors and give their opinion whether the investors should buy, avoid, or whether in case if they have any neutral stance they mention in the research report. So this, their research report is purely based on the offer document prepared by the company, which is shared on the websites of all leading stock exchanges. So an offer document covers all relevant information to help the investors to make his or her investment decisions. So this point is something which I had mentioned to in yesterday's session also, that this document is the basis of decision making, and investors closely go through all the content given in the prospectus, and based on that they come to a conclusion whether to buy or not to buy the shares issued by the company. Okay, then we also have another interesting category which is called the draft red herring prospectus, popularly known as DRHP. Now this DRHP is nonetheless similar to your draft offer document, because this is also is in draft stage. But yes, there are differences between draft offer document and draft red herring prospectus. Now, what are the differences? Prospect, this DRHP does not have details of either the price or sometimes number of shares being offered or the amount of the issue, which means draft offer document and draft red herring prospectus, they are same technically speaking, except on few things. What are those few things? Draft red herring prospectus will not have the pricing information. Pricing information means at what price investors will buy the share. That information is not there in the draft red herring prospectus, but the same information is available in case of draft offer document. So in draft red herring prospectus, you will not have the pricing information. Now, in case if pricing information is not available, then how will public come to know at what price they have to buy? That is communicated at a later stage through an advertisement. So pricing information is revealed later. And it's sometimes it's not just the pricing information. Sometimes you may not have data as to how many number of shares the company is issuing in the market to the public and how much is the amount which the company will borrow by issuing the shares. So sometime any of these three data would be missing in the prospectus, and that's the reason why it is called draft red herring prospectus. Now this data is notified at a later point in time, especially the pricing information is communicated to the subscribers, to the investors, uh, at least one day prior to the opening of the issue. So if a company is issuing shares tomorrow, one day before itself, the pricing data is revealed. That's actually the minimum. Before that itself, the company will usually reveal the pricing data. It will not wait for the last minute because investors should know in advance how much is the pricing, because pricing is the basis of decision making. As I mentioned to you in the last session, that if the pricing is on the higher side, investors will feel it's not worth buying the share at such an exorbitant price. But if the pricing is low, definitely if the prospects of the company is extremely good, it will attract a lot of investors, creating a huge demand. So pricing needs to be done correctly, and pricing has to be communicated to the public, and that's what is done in case of draft red herring prospectus. The pricing is not mentioned in the offer document, but at a later time it is communicated through the advertisements. Now, only upon completion of the bidding process, the details of the final price are included in the offer document. Now, what is this bidding process? Because as per the law, draft red herring prospectus has to be converted into an offer document. So this happens only after the bidding process. Now, what is this bidding process? We will discuss little later. Now, the offer document, once the bidding process is over, once the price is finalized, that price is mentioned in the draft red herring prospectus. And as usual, as per the mandate, this prospectus will be filed with the registrars of the company, which is a mandate because you need to give complete information, and registrar should have complete information about all the companies. So therefore, this document gets submitted to the registrar of the company. So these are the three types of prospectus. Draft offer document, which is uploaded on the website of SEBI, which has all the information, but the document is yet to be cleared. Clearance comes in the form of observation letter. So once the SEBI issues observation letter, if there are no observations, yes, it becomes offer document. If there are observations, those observations needs to be incorporated in the prospectus. And once the Once the observation comments are incorporated, it becomes an offer document. Now, draft red herring prospectus is similar to your uh, draft offer document. Only difference is that here you don't have the pricing data. Pricing data is given at a later point in time after the bidding process is complete. Now, what happens in case if you give false, incorrect information in your prospectus? Because the basis of deciding whether to buy or not the shares is the information given in the prospectus. But what if that itself is misleading, incorrect, fraud? The answer is it will invite legal repercussions. So there is a separate section in the law, section 34, which terms any kind of misrepresentation as criminal liability. So any statement which is untrue, misleading in any form or context, which is included right in the prospectus or deliberately avoiding some important information. It's not only giving wrong information. In case if you have avoided some important information, you have deliberately missed some important points which you should have mentioned in your prospectus, then what happens? The concerned promoters of the company will be held responsible for this. And as I mentioned, there are legal repercussions, which includes both fine as well as imprisonment. The imprisonment term ranges from 6 months to 10 years. On the other hand, the fine amount depends on the kind of fraud committed by the company in the prospectus, and the fine depends on the quantum of fraud committed by the company. So that would be decided by the court of law. So that's the criminal liability for misrepresentation and misleading or avoiding any information which was absolutely necessary, but the company did not mention it. So in today's session, I want you also to revisit the prospectus and explore some of the other aspects. Especially, there's one very interesting section in the prospectus which I personally found it to be very interesting, and that is the uh, liability and case proceedings against the company, the ongoing case proceedings. So companies will have ongoing court cases against it. That is also mentioned in the prospectus. So when we say ongoing cases, there are two categories in that. One, cases filed against the company. Second, cases filed against the promoters of the company. That also should be revealed in the prospectus. In case if a company loses the case, what will be the quantum of compensation the company liable to pay? For example, let's say a customer has filed a case against a company, right, for some reason. And if the customer wins that case, how much money the company is liable to pay to the customer? What is the quantum of loss the company might incur? So that also should be mentioned, right? Let's say there is a tax case going on between the company and the commissioner of income tax or the tax department. So what is the amount involved in the case? So let's say if the company loses the case, the company might pay 500 crores to income tax department. That's the case. That's the entire issue for which the company is fighting the case with the income tax department. So that also should be mentioned, because in the near future, as I mentioned in this example, if there is a case between the company and the tax authorities, if the company loses the case, which means the company is now liable to pay, let's say, 500 crores. From where will it pay? The answer is it has to pay from shareholders' money only, right? So in that way, shareholders will definitely get disappointed because company did not follow the legal process. Company did not follow the necessary protocols. As a result of which, the company is paying a lot of fines and penalties in the court of law. So it's a loss to the company, and this may also hit the share price in the stock market. The share price may decline on account of the fines and penalties paid by the company for its wrongdoings. So it may have severe impact on the share price of the company. So therefore, it's better to look into these kind of information also in the prospectus and figure out if there is any legal, you know, uh, mandate in which the company will end up paying a lot of fines if it loses the cases in the court of law. Similarly, there are personal cases also that needs to be mentioned. If promoters have any personal case against them, that should also be revealed in the prospectus, because at times promoters definitely play an important role in giving the direction to the company. They are the one who make all these strategic decisions, important decisions of the company. So in case if a promoter is arrested, in case a promoter is jailed, imagine what will happen to the reputation of the company. Imagine a CEO of the company getting arrested. If such thing happens, it will dent the image of the company, and immediately the stock prices in the stock market will also fall. So therefore, it is very important that you reveal all kind of information in the prospectus and don't hide anything from the public. That is what SEBI is saying. Now, what happened? I'm sure you have heard of this restaurant called Barbecue Nation. Uh, so recently, Barbecue Nation also went public, but its IPO was put on hold. Its IPO was put on hold because there was a case which was pending. The verdict of the case was pending, and therefore SEBI said, okay, till the verdict of one of the case which is going on against your company, till the verdict comes, we'll put it on hold. Once the verdict comes, you can proceed with the IPO. So, anyways, the verdict came, and the company was later allowed to issue shares. So, this is purely done keeping in mind the interest of the shareholders. One of the objective of the regulatory body, SEBI, Securities Exchange Board of India, is to protect the interest of the investors, right? And things like this can definitely affect the interest of the investors, and that's the reason SEBI wants to be more cautious when it comes to approval of IPOs, when it comes to clearances of IPOs. That's the whole idea behind it. Now, moving on to the content of the prospectus, something which I did ask you in the last session to go through. So this is the broader image, what you get to find in the prospectus. So these are the things which specifically you have to study, even though I did mention it to you that a prospectus has hundreds of pages and it becomes extremely difficult for individuals like us to read every single line mentioned in the prospectus. And at times, forget about us, because you are a finance student, you at least have some idea about the terminologies mentioned in the prospectus. For a layman, some of the terms a layman might not even understand also, because the entire terminologies used is quite technical in nature, even though there's one separate segment in the prospectus called glossary, which will have meaning of all the important terms used in the prospectus. But still, for a common man, the jargon is quite difficult to break down. So therefore, individuals like us, we sometimes heavily depend on the ratings given by the stockbrokers, because stockbrokers in detail they analyze the content of the prospectus and give suggestions. So for people like us, we go by the suggestion given by the stockbrokers. But I did mention it to you, sometimes these stockbrokers are, you can't really trust them, because they purely give decisions that they purely give recommendation, not actually to benefit the investors, retail investors, but to benefit themselves. So therefore, we need to be extra cautious when we are actually going by the advice of the stockbrokers, and do your own due diligence. So, what are the points which you should not miss in the prospectus? These are the points which I want you to specifically focus in the prospectus. So, these are the points which you need to study a little in detail. And these are the five headings. First is the risk factors. So internal risk factors, which purely is occurring on account of the management actions within the company. So risk factors need not necessarily always comes from outside. Risk factors may also uh, arise on account of poor decision making within the company. So managers, the executive team that makes the strategic decisions at times might end up taking a wrong decision. So we can't blame that, this is the fault of the external forces. So we can't blame customers, government for this. Who has to be blamed? The internal executive management for taking wrong decisions, for having lack of expertise, for having lack of knowledge. They might end up taking decisions which are actually not good for the growth and development of the company. So there are internal risk factors, there are external risk factors. Litigations is something what I was talking to you about. So litigations is something which needs to be checked in detail. Then you have summary of industry. This is a very good, uh, I would say, analysis which would give you a very good picture, because summary of industry talks about the industry trends and industry performance, and every company is a part of the industry. All companies doing a similar kind of business in aggregate, all these companies combined together is termed as an industry, right? So all your airline companies put together, they are known as aviation industry, right? All your schools and colleges put together, it's an education industry. So if the underlying assumption is that if the industry itself is not performing well, definitely a company will also not do well. So that's how the logic is. And a very good example of this is your airline industry itself. So during the COVID, especially second and the first wave, most of the flight operations were banned, cancelled. As a result of this, any airline across the globe did not make any business. Forget about profit, that they were not able to generate basic sales. So it was a huge loss. The entire aviation industry in itself was under stress, not just one or two airline companies. So that's the reason you need to focus on industry analysis, because if the indicators are not in the favor of industry, definitely you as a business who's the part of the industry, you will also not do well. But on the other hand, if the indicators of industrial performance is very good, in that case, there is a chances that the company which is a part of a specific industry will do extremely well. So that's the reason why we have to closely have a look at the industry performance also. Then comes the company profile. So these are the important points which are discussed. One is the overview, the strengths of the company, the distribution network, most importantly, the business model. The business model talks about the manner in which the company generates sales and profits. So, what is the key operational activity, and what are the other activities carried out by the company as a part of its operations? How the revenue generation happens, how the sales happen, that is all part of the business model. Then comes the general information. It's a big list here. Then come the information about the offer, something which I definitely wanted you to go through. Objects of the issue. So this is very interesting, because objects of the issue talks about why the company is issuing shares. At times, objects of the issue will contain information like to repay loans. That is where you should be very careful, because a company is taking money from public by issuing shares just because it wants to get rid of the existing loans, which means your money will not be put in the future expansion and diversification of the company, but your money will rather be used for replacing the loans. So in such cases, preferably you should, think twice whether to go with this company which is borrowing money from you just to repay the loans, but not for the growth and progress of the company. So at times you have to study that also. That is also extremely important. Then comes deployment of net proceeds. So how your net proceeds, meaning to say how the money collected will be utilized for various purposes. Then your financial information. So you need to look into the balance sheet, study the capital structure, see how much loans the company already having, whether the company is paying all the loans correctly, all the loan installments correctly, whether the company has any chance of getting insolvent in the near future. So all that data you have to analyze with the help of information given in the financial section of the prospectus. So these are the areas which you have to probably not neglect and have a detailed study on all of these components. Now, once you go through this, you will get a complete idea. After the prospectus are ready, right after it is made available to public, after the pricing information is revealed, now it's the most eager moment for the merchant bankers and as well as the company, because now they will be waiting to know how is the response of the public. And the response from the public, as I mentioned, purely depends on your pricing, how well you have priced the issue. Now, in the context of pricing, there are a couple of options. There are different methods of pricing the shares, right? But before that, you should also know how price is decided, on what basis the price is decided, who decides it. So the answer to this question is the price is determined and analyzed by the merchant bankers. And merchant bankers, along with the issuing company, they both sit together and finalize the price. Once the price is finalized, this price is communicated in the prospectus, or in case of draft red herring prospectus, it is communicated to public at a later point in time before the issue is open to the public. So price discovery is the crux. It's an important step. So price discovery is the process of determining the price of the share in the marketplace through analysis done by the merchant bankers. So merchant bankers' due diligence, their analysis plays an important role in deciding the price. So merchant banker has to take into account so many factors to finalize the price. So factors includes past performance, current trends, and the future prospects. And of course, there are other things which are also analyzed. How government policies will impact the performance of the company, how changes in the economic policies and changes in the business cycles will impact the company. What are some of the unique strengths of the company? What are some of the competitive advantages of the company? By looking into all these factors, only the merchant bankers will decide the price. And companies are allowed to freely price their issues. There are no restrictions from SEBI that you cannot fix such a huge amount of value, right? So SEBI does not actually uh, curtail any kind of decisions taken by the company about the pricing. The companies are completely free to decide the price what they want to, because SEBI believes that giving freedom is essential, and let the people decide whether they want to buy a particular share at that price point or not. So SEBI believes in giving freedom to the investors to decide, and SEBI does not wants to put any restrictions here. So SEBI does not play any role in deciding the price of the shares, in pricing of the issue. So this is something which you have to keep in mind, that the price discovery is purely done by the merchant bankers in consultation with the issuing company. So when it comes to pricing the issue, there are three different options that are available with the companies. So let us go through all these three options one by one. So the first option, the first method of pricing is called fixed pricing method. Now, The name itself says what kind of pricing method is this. This is a pricing method which is predetermined, which is fixed, and this is something which cannot be bargained, right? I mean, obviously, share price you cannot do bargaining. So the amount whatever is decided is fixed and it is communicated to the shareholders. So when the issuer at the outset decides the issue price and mentions it in the offer document, it means the price is already mentioned in the offer document. And if the price is already stated in the offer document, then it is called fixed price issue. The offer document justifies the price with qualitative and quantitative factors. So once the price is mentioned in the offer document, there's also a justification and analysis given by the merchant bankers as to on what basis did they arrive at this price point, which is already mentioned in the prospectus, which is already decided. Then you have the uh, second method of pricing, which is called the differential pricing. Now, what is this differential pricing? Differential pricing means you're offering the shares to the subscribers or the investors at different rates, not at a uniform fixed price like the one which we have in the first method. So here what happens, you are offering shares to different investors at different prices. So when you're offering shares to different investors at different price points, it is called differential pricing. For example, let's say a retail investor in this case is eligible to get 10% discount on the issue price. Similarly, a company can also offer discount to its employees, and a company may offer the same shares without any discount or probably a little higher price to the institutional investors. So when a company has different price points for different types of investors, then this method is called differential pricing. But both these methods are not popular. The most popular method of pricing is called book building method. Can you just recall book building? Where did we use this term? While discussing SEBI guidelines and SEBI norms for issuing shares, I did ask you a question. What if the company which wants to issue shares is a loss-making company? Can a loss-making company issue shares? Can a company which does not meet those criteria prescribed by SEBI, can that company also issue shares? The answer is yes, but two conditions have to be met. One is the company should strictly follow book building pricing. And second, the company should follow the quota system 75, 10, and 15. So what is this book building? This is when I mentioned it to you that we will discuss in today's session at a little later point in time. What is book building? Now, book building is also a method of discovering the share price. But what happens in book building process is that you are not deciding the price. The price is not predetermined. If the price is predetermined and if it is communicated in the prospectus, then it is called fixed pricing. But here in case of book building, the price is not decided in advance. But what is decided in advance is the price range. So price range is decided. So when you say price range, it's kind of a band. Let's say 100 to 120 rupees. This is called a price band or a price range. Now between 100 and 120 rupees, the investors who are willing to subscribe the shares, let them decide what price they want to bid at. The option is given 100 to 120. I'm just giving you an example, 100 to 120. Now, when we say 100 to 120, this is called a price band. Now, if you closely look at this so-called price band, It has two prices actually. One is 100 and the other one is 120. So what is this 100 and what is this 120? Now the lower end of the price band, the lower end of the price band is called the floor price. The higher end of the price band, which is in our example 120 rupees, is called the cap price. So 100 is the floor price, 120 is the cap price. Now, apart from this, in book building, you also have to communicate the lot size. Lot size means a minimum number of shares which the investors should apply for. In case if they apply for a number of shares which is more than this prescribed minimum number, they will not get any kind of shares. And remember, during the IPO process, when you're buying shares directly from the company, you cannot buy shares according to the choice, your choice. So you cannot say I'll buy one share, two share. It's not possible. You can buy the quantity of your choice in the secondary market, in the stock market. Once the share is listed and available publicly for trading, you can buy as per your quantity. So from stock market, you can buy even one share of a company. But when you're buying shares directly from the company in the primary market during the IPO process, you have to buy in lots. So the company will decide the lot size. One lot is equal to 1,000 shares. So if you want to buy more than 1,000, then what you should do? Then you should buy in multiple of lots. So when we say one lot is equal to 1,000, if you want to buy more, then you have to buy two lots. If you buy more than this, you have to buy three lots. So either you have to buy a minimum lot or in multiple of lots. Okay, so that's how it works. Now, what is tick size? Tick size is simple. It is lot size into the price per share. So price per share, uh, which is mentioned in the band, into the uh, you know number of shares, and the price at which you finally end up getting the share is called the cutoff price. So this is what happens in book building process. In book building process, the price is not predetermined, it is not fixed, but rather the merchant bankers, they decide the price band. Price band will have two prices, one lower price and one higher price. The lower end of the price is called the floor price. The higher end of the price is called the cap price. So this is communicated to the investors through an advertisement. And investors have to decide whether they want to apply at a lower price, which is the floor price, or at a cap price. Generally, investors don't take the risk and they always apply for share at the cap price, because when the demand is too high, obviously most of them would have applied at a cap price. No one would want to take the risk and apply at the floor price. So what happens in the next step is that the investor will go for the bidding process and they will apply for shares online. These days, everything is online. But there was a time when things used to happen offline, and that was a very challenging scenario. So, what used to happen? Investors used to collect the bits, physical bits in the form of an application form. So, investors used to separate those bits based on the price, based on the type of investors. And they used to write down, okay, application number 101, what is the bidding price? Application number 102, what is the bidding price? Imagine if this, like this, there are 15 lakh applications. In order to record 15 lakh applications bidding price, how many books do you need? How many ledgers do you need? Obviously you need at least 10,000 books to record all this information. And that's where the name came, book building, because the book running lead manager, the one who does the data collection, right, is to, we used to call them as book runner or the book running lead manager. That's nothing but your merchant banker. A merchant banker is called book running lead manager. So he will keep building the books, because imagine, as I mentioned, 10 lakh shareholders, 15 lakh applications you have received, and 15 lakh applications pricing information has to be entered in the books. So obviously the books would build up. So many books he would collate. But now nothing of that sort happens, because everything is computerized. All the data is just generated at a click of a button. So the software will tell which is the highest bidded price, whether it is the floor price or whether it is the cap price. So now the things are much more simplified, right? So not just for company, even for investors, the things are quite simple now, because applying for share applying for shares has now become very simple and easy. Not like earlier. Earlier the process was quite complicated, but now if you have a trading account, if you have a bank account, it is very easy to apply for shares. Probably I'll show that process a little later as to how you should go about applying for share. But the thing is that now it's very easy and simplified. So once the bits are collected, depending on the demand, as I mentioned, if the demand is too high, the investors will always bid at the cap price. And in case if majority of them have bidded at the uh, cap price, then that itself will become the cutoff price. So that will be the price at which the company will finally issue the shares to the public, right? So that's how it works. Now the question is also, what should be the gap between the cutoff price, between the floor price, which is the lower end of the price, and the cutoff price? What should be the difference? Can the company have, let's say, a floor price at 100 rupees and a cutoff price at 200 rupees? Is it possible to do? Is this allowed? The answer is no, it's not allowed. There is a percentage which is fixed. The gap between the floor price and the cutoff price cannot exceed this margin or the percentage which is predetermined by SEBI. So SEBI says your floor price and your cutoff price should have a margin of difference that does not exceed 15%, 1 5. So the difference between the floor price and the cutoff price should not exceed 15%, right? So if it exceeds, then it's not allowed. You can't do that, right? So that's how the gap, that's the difference between the floor price and the cutoff price, right? So these are the three methods of pricing an IPO. So I'm sure now you have some sort of an idea as to what do you mean by fixed pricing method, what do you mean by differential pricing method, and what do you mean by book building method. So these are the three methods of identifying the price, or these are the three methods of price discovery which a company can opt for. So a company can opt for any one of these three methods. Now, apart from this, one of the important aspects of a book building process is that book building process mandates you to go for reservation system, something which I had mentioned it to you earlier, and some of the other important procedures which is applicable not just for book building but for other pricing methods is what is mentioned in those last three boxes. What is the duration of the issue being open to public? which means company can keep the window for public to subscribe for its shares not more than 3 days. Usually it is kept for 3 business days. The holidays in between are not counted. And in case if there's a very poor response, very bad response, what happens? Public has not applied, you have not got, all your shares are not sold, in simple words. In that case, SEBI says you have the option of revising your price. If you feel that you had actually priced your share on a higher side and unfortunately, you know, people did not apply for the shares, and the response was very bad, in that case, you can do a revision. So revision to the price can be done. So that is also possible. And SEBI gives you a duration for which you can do the revision. So SEBI says, yes, you can do necessary revisions to your pricing and again communicate the new pricing to the investors, for which 10 days time is given. So in case price band revision, the issue can be extended up to 10 days. And it did happen recently. I'm sure you would have heard of this very popular uh, health insurance company in India, which is Star Health. So Star Health did issue shares recently. It came up with an IPO, but unfortunately, its shares had a very bad response. The response was very bad from the investors. So it did had issues in fulfilling the uh, minimum subscription requirement. But anyways, we'll discuss a little more about what went wrong with Star Insurance a little later. Right. So what are the three categories of investors and how do we categorize them? So the answer to this question is the categorization is based on the application value, because in individuals we have two categories: retail investors and high net worth individuals. So both these are in individual investors. So if you are applying for shares and if your application amount is less than 2 lakhs, then you are categorized as a retail investor. But if you're applying for a share and if your application amount exceeds rupees 2 lakhs, then you're categorized as high net worth individual. And of course, you also have qualified institutional buyers who are basically financial institutions. So in book building process, this is the quota or the reservation system what you have to adhere to. One is retail investors should be given 35% of the shares. Then you have your HNIs, they're also known as non-institutional investors. So they should be offered 15% of the total issue. And the remaining 50% should be given to qualified institutional buyers. This is what happens in book building process. But in case if the company does not meet the criteria prescribed by SEBI, right? In case if the company fails to meet the criteria prescribed by SEBI, then this reservation system will change. So 75% for QIBs, 15% for uh, retail investors, and 10% for high net worth individuals. So the entire equation changes, right? So these are the different methods of pricing an IPO.